Imagine waking up one morning, grabbing your coffee, and seeing the news that the United States government is suddenly stepping in to help Japan's currency. And we're not talking about a nice diplomatic speech here. We are talking about billions of actual dollars being actively used to buy up Japanese yen. Well, welcome to this explainer. Today, we're unpacking a really fascinating story about a foreign currency crisis that secretly, and actually very directly, threatens everyday American wallets.
The whole spark for this mystery, it actually comes from a single wild photograph taken during a U.S. cabinet meeting back in July 2026. Somebody managed to snap a picture of U.S. Treasury Secretary Scott Bessent's handwritten to-do list, and literally right there, scribbled on the page, was this incredible line, buy Japanese yen $5 to $10 billion. Just a few handwritten words, but man, they instantly revealed that something massive was going down behind closed doors. So that begs the obvious question, right? Why would America spend billions supporting another country's currency? Now, the easiest, most feel-good answer is just friendship. Japan is a major U.S. ally. But let's be real for a second. Friendship alone absolutely doesn't explain the sheer massive financial risk of bailing out a foreign currency to the tune of billions of dollars. There had to be a bigger, much more self-interested reason at play.
Section 1. A billion-dollar mystery.
Let's quickly look at the exact conditions that triggered this. For years, Japan had kept its interest rates extremely low. That kind of set the stage. Then, fast forward to July 2026, and the Japanese yen suddenly gets hit with this crushing pressure, collapsing to levels we basically haven't seen in about 4 decades. It got so bad, so fast, that by late July, the U.S. started quietly tapping banks on the shoulder about a possible intervention. And shortly after, boom, a fully coordinated rescue was executed. Honestly, the speed of this whole timeline just shows you how completely panicked both governments really were.
At its absolute worst, in July 2026, the exchange rate hit 163 yen per dollar. And for Japan, that was a total nightmare. You see, Japan relies heavily on imports just to keep the lights on, especially for energy. So when the yen gets that incredibly weak, every single one of those imported barrels of oil becomes crushingly expensive. Inflation started skyrocketing. They were in real, serious trouble.
Section 2. The Treasury Bond Connection.
So how exactly does a crisis in Tokyo become a 5-alarm fire in Washington? Well, it's a giant financial domino effect. For years, Japanese investors parked their money overseas, especially in the US, because rates at home were so low. But as the yen weakens and Japanese rates start to tick up, the math flips. Step 1. The yen weakens. Step 2. Japanese investors now have a huge incentive to bring all that capital back home. Step 3. To do that, they have to sell off their American assets, specifically a massive amount of U.S. Treasury securities. And step 4, when you dump that many U.S. Treasuries onto the open market, bond prices drop and U.S. Treasury bond yields absolutely spike.
And this is the crucial part. A spike in Treasury yields isn't just some boring, technical Wall Street problem. It is a you and me problem. Because when yields rise, borrowing costs across the entire American economy shoot right up. Suddenly, if you're trying to buy a house, your mortgage is way more expensive. Corporate borrowing costs jump, which puts a chokehold on businesses trying to grow. And the U.S. government? Well, they're already sitting on a mountain of debt, and suddenly financing that debt becomes a whole lot harder.
Section 3. America's Hidden Motive.
So Washington definitely wasn't just being a loyal friend to Tokyo here. What they pulled off was a coordinated intervention. That's when multiple governments throw massive amounts of capital at a collapsing currency to basically force it to stabilize and stop a global panic. By working together, the US and Japan stepped in and successfully wrangled the dollar down from that terrifying 163 yen mark, bringing it back to the mid-150s. On paper, looks like a classic superpower rescue mission.
But underneath, it was purely mutual self-interest. Japan obviously needed a stronger yen, but America? America desperately needed financial stability. Think about it. If Japan had to fight this off all by themselves, they would have needed dollars to prop up the yen. And to get those dollars, Tokyo would have been forced to sell off massive chunks of their U.S. treasuries. Washington acted defensively because they absolutely, under no circumstances, wanted to see a huge treasury sell-off spiral out of control and blow up American borrowing costs.
Section 4. A temporary Band-Aid.
Now, the intervention worked for the moment, but is this dramatic billion-dollar bailout actually going to hold? The harsh reality is that throwing money at a currency doesn't magically fix an economy. There's still some powerful, fundamental forces just crushing the yen right now. You've got the massive interest rate gap between the US and Japan. You've got persistently high energy prices weighing down Japan's economy. And honestly, just basic investor expectations. People expect better returns in dollars. Money naturally flows where it's treated best, and a one-off intervention can't just permanently defeat those basic economic incentives.
So Japan is stuck making an impossible choice. On the one hand, the Bank of Japan could raise interest rates to protect their currency, but doing that risks slamming the brakes on their entire domestic economy. On the other hand, they can keep rates low to help the economy grow, but then the yen keeps getting hammered. It is the ultimate catch-22. At the end of the day, governments can fight the markets for a little bit, but they cannot permanently ignore economic fundamentals. Gravity always wins. Sure, this historic move shocked traders and definitely hit pause on currency speculation for a minute, but market analysts, they are incredibly skeptical. And actually, the yen has stayed under pretty heavy pressure even after this massive, multi-billion-dollar bailout.
Section 5. The Fragile Financial Web.
So what does this whole crisis actually teach us about the modern global economy? It shows us exactly what Washington was so afraid of: financial contagion. When a currency collapses, markets panic. That panic triggers massive, unpredictable shifts of capital all over the world. Those shifts completely destabilize global bond markets. And once the bond markets get shaky, the problem spreads like wildfire, way faster than any government can track. America stepping in was basically a giant flashing warning sign to the markets, saying, do not let this spiral out of control.
And that brings us to the uncomfortable truth of the 21st century economy. The yen might have been the patient here, but America had its own reasons for calling the ambulance. We're just not a collection of isolated countries anymore. We are one giant, ultra-sensitive financial web. A currency problem in Tokyo is inevitably, and sometimes instantly, a borrowing problem in New York. America was really just protecting itself from an economic earthquake.
Which leaves us with one final kind of chilling question. If the yen falls again, is America going to step in again? If Japan's interest rates stay low and energy stays expensive, the yen is still super vulnerable. Doing this once was already highly unusual. Doing it twice? That would signal to the entire world that America's own financial stability is fundamentally chained to Japan's currency. It's the exact question every single investor is watching right now, and it should definitely make all of us look at our interconnected world just a little bit differently. Keep your eyes on the markets, and thanks for exploring this explainer with us.